All right, let's get right into it. Oil prices are climbing to multi-week highs, and it's because they're caught in this powerful pincer movement. You've got optimistic demand forecasts on one side and some serious supply risks on the other. Today, we're going to break down exactly what's pushing crude higher. So let's start with the big number of the day. Brent crude, that's the global benchmark, just closed at $63.75 a barrel. Now, this isn't just a little jump. It's the highest price we've seen since the middle of November. That's a pretty big deal and tells you sentiment is really starting to shift. And it's not just Brent. Over in the US, West Texas Intermediate also broke through a key level, hitting $60.08. Both of these benchmarks have had some pretty significant gains this week. Brent's up about 1%, but WTI has surged around 3%. So yeah, the momentum is definitely building.
So, what is going on here? Well, it's not just one thing, it's two massive forces hitting the market at the same time. On one hand, you've got this huge bet on monetary policy that's making everyone feel good about future demand. And on the other hand, you have this high-stakes geopolitical chess game that's threatening to squeeze supply. Let's unpack it.
Okay, first, let's talk about the demand side of this equation. This is all about what the market expects to happen. And right now, there's a massive bet that the U.S. Federal Reserve is about to cut interest rates, which would make borrowing cheaper and hopefully kickstart the economy. And you can see just how sure everyone is. I mean, look at this. Traders are pricing in an 87% chance that the Fed cuts rates at its very next meeting. That is an incredibly strong signal. The market is basically screaming that it expects cheaper money, and that has huge implications for energy. So how does a rate cut actually lead to higher oil prices? Well, it's a pretty clear chain reaction. First, the Fed cuts rates. That makes it cheaper for businesses and for you and me to borrow money. That, in turn, stimulates the economy, right? More factories running, more trucks on the road, more people flying. And what does all that activity need? More energy. It leads directly to higher oil demand. And you know, there's another piece to this puzzle. A rate cut usually weakens the US dollar. And since oil is traded in dollars all around the world, a weaker dollar makes crude oil cheaper for anyone buying it with another currency. That can give global demand another little boost, adding even more upward pressure on the price. Now let's look at the other arm of the pincer. While everyone's getting optimistic about demand, the global supply situation is getting, well, a lot riskier. Geopolitical tensions are really starting to bubble up, and it's making the market very, very nervous. A big piece of this is that the peace talks between the US and Russia over the war in Ukraine have completely stalled out. And as Reuters points out here, that lack of a breakthrough gives the market what they call a bullish backdrop. Basically, it means that the risk of that conflict flaring up and disrupting supply isn't going away. It's just there, supporting prices. But now, something much, much bigger is on the table. The G7 and the EU are reportedly talking about a huge shift in policy, moving away from the current price cap system for Russian oil to a full-on ban on maritime services. If this happens, it is an absolute game changer. So here's how this ban would actually work. It would make it illegal for shipping companies in key European nations, we're talking Greece, Cyprus, and Malta, who are huge in the oil tanker business, to transport Russian oil anywhere. And this isn't just talk, it's being seriously considered for a sanctions package as soon as early 2026. To really get why this matters, you have to see how Russia moves its oil right now. About 2/3 of it travels on what's called the shadow fleet. These are old tankers, often with sketchy insurance, operating outside of Western rules. But, and this is the key part, a full 1/3 of their oil still relies on modern Western tankers. That's the supply this ban would go right after. So if you take away that Western tanker capacity, Moscow is suddenly forced to rely 100% on its own aging shadow fleet. You can just imagine the logistical nightmares that would create. We're talking major bottlenecks, a higher risk of spills and accidents, and ultimately, it would just be harder for Russia to get its oil out to the global market. And hey, the risks don't end with Russia. The market's also got its eye on Venezuela. There's 1.1 million barrels per day there that could be at risk if the US decides to take military action. And you just have to add in recent flare-ups, like a Ukrainian drone attack that started a fire at Russia's port of Turmoilt. It all adds up to a very tense supply picture. So what happens when you get rising demand hopes crashing into these very real supply fears? Well, you get a recipe for a really volatile market. Let's take a look at how this could all play out. This chart really lays out the tug of war that's happening right now. On the bullish side, the things that could push prices even higher, if the Fed delivers that rate cut and the G7 actually enacts that maritime ban, look out. But on the bearish side, if the Fed surprises everyone and stays hawkish, or if that sanctions package gets watered down or delayed, this rally could run out of steam fast. So the main thing to take away from all this is that we should all prepare for some serious volatility. Traders are hanging on every single headline, whether it's coming from a central banker or from a conflict zone. Big price swings are probably going to be the name of the game for a while.
All right, that was a lot to cover. Let's boil it all down to the most important takeaways.
And really, this is the one question everyone in the market is asking right now. What's going to be the bigger driver? Is it going to be the optimism about the economy thanks to central banks? Or is it going to be the real-world anxiety over supply disruptions? The tension between these two is what's going to decide oil's next big move. So, to sum it all up, this oil rally isn't a simple story. It's a perfect reflection of two competing forces: financial optimism and geopolitical fear. And the two things you absolutely need to watch are the outcome of that next Fed meeting and any news at all, on that proposed maritime ban on Russian oil. And finally, just a quick reminder for everyone. This content is for educational purposes only. It is not investment advice. The energy market is incredibly complex, so please always make sure to do your own research before making any decisions. Thanks for tuning in.